Is Japan's inflation slide a buying signal or a warning for your portfolio? Here's what the latest data means for rates, earnings, and market moves you can use. Japan's consumer inflation cooled to 1.3% in February. That is the softest pace since March 2022 and below the Bank of Japan's 2% target. It marks a fourth straight month of easing. Core inflation also missed forecasts. The surprise is not huge, but it sharpens the focus on how fast policy can normalize and how resilient domestic demand really is. For rates, a 1.3% headline print argues for patience. The gap to the 2% goal has widened, which complicates any case for rapid tightening. Markets may dial back expectations for quick rate hikes and a fast exit from easy policy. That can steady front-end yields and keep the yield curve relatively anchored, at least until wage data or services inflation reaccelerate. For the yen, a more patient BOJ lowers the odds of a sharp, policy-driven jump. If currency expectations stay range-bound, exporters may gain clearer earnings visibility than in a rapid tightening scenario. But a very soft inflation path can also cap the yen, which helps overseas revenues but raises import costs. Net effect depends on oil prices and global demand. For equities, the picture is mixed. Domestically focused retailers and services could benefit from easing input pressures, yet softer pricing power may weigh on margins and revenue growth. Pricing discipline and cost control will matter more than headline traffic. Export-oriented sectors could hold up if currency volatility stays low and global demand stabilizes. Defensives may look attractive as earnings visibility becomes a premium and bond yields remain contained. For bonds, cooler inflation supports demand for JGBs and may temper volatility. Credit spreads could stay orderly if lower inflation offsets growth worries. Duration risk looks more manageable when the central bank is in no rush. For earnings season, watch guidance tied to wage trends, pass-through capacity, and FX assumptions. Companies that pivot from price-led growth to volume, mix, or productivity gains may outperform. Pay attention to firms with flexible procurement, energy hedges, and exposure to external demand. Here's the practical takeaway. Position for a slower, steadier normalization path. Favor quality balance sheets, resilient cash flows, and exporters with currency agility. In domestics, look for operators with cost levers and sticky demand. Keep an eye on wages, services inflation, and the yen for the next inflection. Read the full article at finlitica.com. Quick reminder, this is general information, not financial advice. Your money, your decisions, so always do your own research.